What is going on, investors? Hopefully, guys are doing well out there. Time to talk about DocuSign, ticker symbol DOCU. I'm seeing in the after hours, after reporting Q1 earnings, this stock is down over 20%. That's on the heels of year to date being down 44%, and over the last year down 63%. We'll talk about these Q1 earnings. We'll take a look at the revenue, the profits, the Q2 outlook. They also gave us full year guidance as well. We'll take a look at both of those things and always keep it in context of this 16, probably closer to about $15 billion valuation on DocuSign if the after hours move in this stock downward carries over into tomorrow. Now, we'll also take a look at kind of the estimates. Where is DocuSign going? Okay, there's a lot of people that are probably still relatively bullish this name. Where's it going from a revenue growth standpoint here in the future? We'll come over here and look at these Q1 numbers as well, and then we'll look at this from a technical perspective. Hello, falling knife. This one's absolutely fallen off a cliff. Now, some of you might wonder, am I an investor in DocuSign? Have I bought or sold this stock in the past? No, absolutely not. I've never been invested in DocuSign. It's a company I've followed relatively closely. Some of you might argue, well, you got no skin in the game. Yeah, that's true, guys. But listening to people with skin in the game, either long or short, is a great way to get a biased analysis on a stock. I don't really care if this stock goes up or down. I want to just see if it's a fair value at its current valuation. Now, we'll come over here and look at these Q1 numbers. Earnings or revenues came in at $588 million. That was 25% growth. I'm seeing here on this side that the revenue growth was closer to 40, 50, 60% in prior quarters. So we're starting to see maybe a little bit more normalized growth rate on this company's revenue. We certainly got that outlook for Q2 as well, with revenues expected to come in right around $600 million. Again, this was Q1 that we'll talk through, and we'll walk through all the expenses, the R&D, the stock-based compensation, the cash flows, the balance sheet. We'll walk through that in a second, but we get outlook for Q2. That's the upcoming quarter, the one we're in the midst of, 600 to 604 million. Again, quarter over quarter, pretty strong growth. Estimates for the upcoming earnings as well was right around 604. So they kind of brought in the outlook a little bit to mirror about where consensus estimates are out on Wall Street. For 2022, paints a similar story. Wall Street was expecting $2.48 billion. This is for the full year. That's exactly where DocuSign thinks they'll likely come in. Now, in terms of that revenue, $2.48 billion, that would be about 18% growth year over year. And that's about what DocuSign is projecting to do over the next couple of years, kind of like low teens, mid-teens growth on that revenue side. So you have to ask yourself, on a company that is trading north of about $15 billion valuation with $2 to $3 billion worth of revenue, you're still paying 5 to 6 to 7 times sales, not earnings. You're paying 5 to 6 times sales on this one. That honestly is still pretty hefty valuation. So you'd want DocuSign to maybe either figure out a way to re-accelerate these sales or really squeeze out a lot of profits, which also some analysts on Wall Street are projecting into the future. Now, done with the projections, let's take a look at what actually happened in the Q1. We talked about how they had $588 million worth of revenue, 25% growth year over year. It did beat expectations by about almost $7 million. You see here, last year we were at 469 on the revenue. This year, 588. One of the bullish reasons why a lot of people got behind DocuSign is, look, this has Adobe and Microsoft type margins, because on this 588, we spent just $105 million on that cost of revenue. You have another professional service cost here coming in right at $27 million. All things being considered, our total cost of that revenue, just $132 million. So off this 588, you minus off 132, you get fantastic and just succulent gross profit over at DocuSign at $456 million. That was up over $100 million over the previous period. So you bolted on north of $100 million worth of revenue, and almost all of that flowed through the gross profit side. That is very, very nice. We're not seeing that across the board on some stocks, okay? Because what's going up? Your input cost, your product cost, your shipping cost, all that stuff is going up, and it's chewing up gross profit all across Wall Street. Not the case over at software companies and DocuSign in particular. Now, what is chewing things up is we've got other operating expenses, unfortunately. We've got selling and marketing. That went from 239 all the way up to 300 million. We've got research and development went from 85 up to 112. And we've got the good old G&A line went from 50 to 62. So our total costs also went up by about 100 million. Notice they were at 374 last year. Now they're up to 475. So you guessed it, that's going to be really bad for our loss from operations. It was 10 million last year. Now it's at 19. That's an almost 100% increase on your losses year over year, despite 25% year over year gains on your revenue. That is very, very negative. I know a lot of investors and a lot of very experienced investors that would click the absolute close button, get this stock off of my screen. This is not a company I personally would want to invest in. And a lot of sophisticated investors would stop right here, because despite the revenue growth, but despite the strong gross profits, none of it is flowing down to the operating side. And then when you come over here and look at this company, the fact that they're going to be kind of a low to mid-teens grower on that revenue side, well, they're really going to have to start getting these costs in check in order to start spinning a profit over at DocuSign. Now, from a balance sheet perspective, nothing really to be concerned about year over year, or in this case, just over the last couple of months. Nothing has really changed from a cash perspective, from a liability perspective. Nothing's really changed over at DocuSign. Now, the bull case argument, all the YouTubers and the FinTwits that are in love with DocuSign, I can't imagine there's many of them now. I mean, some of these guys were pumping this stock over $200 per share. There's not a lot to love over at DocuSign, but if you take bits and pieces of the cash flow statement, it paints an absolutely glorious story. Take a look at our net loss in the most recent period. 3 months, we lost $27.3 million. Again, this is after you pay your interest, income taxes, and all things required to operate a business. Your net income is your bottom line, and you lost $27 million. Last year, you lost $8.3 million. But guess what you get to do on the cash flow statement? We get to add back in $110 million. Yeah, $110 million of stock-based compensation, dollar for dollar, like those employees would have worked for free if it wasn't for the stock. Last year, they were at $80 million. So we grew our losses from operations. Our net loss basically actually more than tripled. Our loss from operations went up nearly 100% from 10 million up to 19. But guess what executives decided to do? They decided to raise their salary from 81 million last year to 110 million. Again, this is not for the whole year. This is not for the lifetime of the company. This is for 3 months. In 3 months, 90 days, we're talking over $1 million a day. $1 million a day over the last 3 months went to stock-based compensation. It's just unbelievable. And these companies are getting absolutely thrashed in this market. And as long as they continue to put up results like this, they will continue to get thrashed. A lot of you were saying this stock used to be $240 and now it's $67. Well, it's going to be $7 here pretty soon if they continue to do these types of results. But guess what? You get to add back in $110 million worth of stock-based compensation. And yeah, it's going to turn your cash flows super positive to $196 million. Last year, you had $135. All the bull cases will just come here, cherry pick this number and say this company is cash flow positive and from a price to cash flow basis is the cheapest stock on this Wall Street. Well, when you really dissect the numbers, you're going to realize the fact that this company is not going to be able to put up $110 million worth of stock-based compensation this time next year. When the stock is going like this, the executives, the employees, the programmers, the engineers, they're not going to want to take the stock. They're going to want to take cash, and that's going to negatively impact the stock continuing on into the future. Now, from a technical perspective, not a lot to see here. Like a lot of stocks, we've just fallen into kind of this downward trend. When it's moved to the top of the channel, and where you draw this kind of channel line in really is up to you, but it's kind of peeked its head up over it a few different times, only to get rejected. In the after hours, we're down towards the bottom end of this range. I don't see a lot of support for this stock until you get south of probably about $50 per share. That's another $16 lower. Me personally, from a technical perspective and probably a fundamental perspective as well, this stock's probably headed back to its IPO price right around that $40 per share. We'll see if it's able to hold that. I would expect buyers, institutions to try to step in at these levels. But again, even if you shed off another $20, $30 off of this stock price, you still got a company that's probably worth 9, 10, 12 billion dollars. Okay, at that point, you're starting to look at like 3 to 4 times sales. While not super cheap, certainly as egregious as this company has been in the past. That was DocuSign. Be careful with these stocks that have shed off quite a bit. If you do jump in this name, I would have a plan. I would have an entry price. I would also have a stop loss set on stocks like this. They would probably be pretty tight underneath where I would buy that. And quite frankly, I would have an exit plan as this stock moves back to the top of the channel or makes some kind of reversal pattern. That's probably when I would want to take profits, because as I showed you, the market cap has absolutely shriveled, but the company's fundamentals haven't quite caught up, and the valuation, quite frankly, over at DocuSign, still a little bit expensive. Hopefully you guys enjoyed today's video. We'll be back again soon with more. Good luck with your investments.